G'day folks, welcome to the video. In this one I'm going to talk about how to live off dividends. It's not easy, but it certainly is possible, and I'm going to show you how to do it. Maybe you're living in a share house, you might be house hacking, renting out the other rooms. Maybe you're a van dweller, you might have a caravan down by the river, you might be living on the cheap in Southeast Asia. The secret to this is keeping your living expenses low. If you're able to keep your living expenses low, that is the secret. Maybe you're doing one of the things I just mentioned. Maybe you've paid off your mortgage or partially paid off your mortgage. This isn't about living a five-star lifestyle, guys. This is about having your basic expenses covered so that you can take the stress out of your financial situation. When things are going well, it means you have extra money in the bank, so you have more choices at your disposal. When things are not going so well, it means you have that money coming in so that you don't have to worry as much, so you can get through the tough times until things do improve. If your living situation changes later on, it's still, you might not want to live off dividends alone, but this extra money is going to give you more choice in your life. If you want to quit your job to start a business, if you want to take 6 months off to travel overseas, this is going to help you to do that. No matter how things turn out, you're going to be thanking your past self for doing the hard yards and making the sacrifice, investing wisely to make the life better for your future self. Okay, so let's have a look at what you might buy to pay out some nice fat divvies. This is not financial advice, guys. I'm not a financial planner. You need to do your own research or get a financial planner yourself if you're not comfortable doing your own research. But I'm going to show you a couple of funds that might get you to where you want to go. All right, guys, here we are. We're having a look at some of the ETFs that are available on the ASX. So basically what I've done, I've pulled up three here. We've got first up, we've got the iShares S&P ASX Dividend Opportunities ETF. This is put out by the firm BlackRock. They control that. And to get to here, I've basically just opened up a page and gone IHD, which is the ASX ticker for it. ASX. Scroll down, and then I've clicked on here to go to the BlackRock page. So here we are, and this is a good starting point for doing your research as well. So at the top you can see overview, performance, key facts, and so on. So you might start off having a bit of a read here of what they're doing, their investment objective, and so forth. And you might also look at the holdings. This is the actual companies that they hold. So you got Wesfarmers, BHP, Woolworths, so some pretty big names there. But we're here to look at the dividend yield itself. So we come to the key facts section. So there's plenty of information here, guys, to help you make up your mind and to do your research. And we're looking at the 12-month trailing yield. And it says here, this is the yield an investor would have received if they had held the fund over the last 12 months, assuming the most recent NAV, that's your net asset value, basically the value of the assets behind the shares, behind each share. Yeah, and it's just some more information there, but that's the gist of it. So what we got here, we got 4.19%. That's your dividend yield, which is basically like an interest rate, but paid out in dividends. And then the next one over, we've gone to Vanguard, VHY, Australian Shares High Yield ETF. And we've gone to the portfolio section here. And this is pretty similar, different provider, Vanguard, but they've got some good information here as well. And here we're looking at the equity yield dividend. And if we hover over this, or if we click on this, the dividend income earned by shares expressed as a percentage of the market price of those shares. For a fund, the yield is the weighted average equity of the shares it holds. So this is basically what you would compare them to each other with, but it's important to note as well that they might use different rationale for calculating the yield on it. So it's not necessarily apples with apples, but at least they tell you how they do calculate it, so you can still make an informed decision here. So VHY, they've got 3.77%. So IHD had 4.19. VHY's got 3.77. And these have come down a lot in the last year or so, guys, as you know, there's probably another discussion altogether, but with a lot of money printing going on and the government stimulus, and the markets have gone pretty crazy and the prices have gone up, but the dividends can only pay out what they have in the bank. So if the income doesn't really go up but the price is going up, that means the yield as a percentage is going to go down, and that's sort of what has happened to an extent. And now we're looking at SPDR MSCI Australia Select High Dividend Yield Fund. That's our third one we're going to look at. There are several others, but these are the three that we'll look at for this example. And here we've got dividend yield in the overview section, and here to see what they say about how they calculate it. Fund dividend yield is the weighted average dividend yield of the stocks in the portfolio divided by the current market price of the stocks in the portfolio as expressed as a percentage. So they got 4.37%. Okay, so now we've had a look at a couple of the funds that are on offer. Let's bust out some real numbers in Excel. And I don't know about you guys, but I really do like a bit of spreadsheet action. So let's get into it. Okay, here we are guys, just a little simple spreadsheet I've done up using the previous examples from the three funds that we looked at. So we've got IHD, VHY and SYI. And here's what they are. All similar versions of or different versions of the same thing. So we've got our dividend yield here that I pulled from the website, and we've just said that we've got $250,000 capital. Now, if you have $250,000, we've worked out our annual dollars here, which is basically the capital amount multiplied by the yield amount gives you the annual amount that you'll earn per year in dividends. And then to get to the monthly amount, we've just divided the annual by 12. So you can see here with 250 grand invested in IHD, you'll earn about $870 a month, VHY $780 a month, SYI $910 a month. So you can sort of play around with these figures here. If you said, I'm only going to invest in one fund, that you probably wouldn't do that. Might be a bit risky, but it's, it's up to you. And you want to make $1,000 a month, let's play with some numbers. 270 won't do it. All right, for 280 invested, you can earn $1,000 a month with SYI. For 290 invested, you're also earning over $1,000 with IHD. And to earn $1,000 with VHY, you need $320,000. So this can go a long way to help you out as far as taking care of your basic expenses go, providing that your living expenses are managed. So if you're living cheaply one way or another, or if your mortgage is paid off, then this probably can go a long way to paying your basic bills, whatever's left over. That's probably, that's for a single person. If you've got a family, it's a different story. But still, it all helps, doesn't it? It's important to note that the quoted yields that are shown here in many cases are probably referring to the grossed up yield. This means that they're showing the pre-tax figure and that the amount you receive will be the net dividend figure, which will have the franking credit taken out. But depending on your income, you may get some or all of the franking credits back when you lodge your tax return. For more information on franking credits and how they work, I made a video about that. I'm going to put it up here. Check it out and let me know if you have any questions. It's also important to note that while big fat dividends might look good on paper, it's not always a good thing. It's not always good business practice to be paying out high dividends. For instance, if a company is taking on cheap debt in order to finance high dividends that aren't sustainable, that will in the long run cause the share price to fall most likely. And this does happen a little bit. I'm not saying it's common practice, but sometimes it might be often better for a company to reinvest money back into the company to boost productivity, to stay out of debt, to stay solvent, to a point where then they can then afford to pay out dividends out of profit, where it is a sustainable profit. Most big fund managers probably aren't going to be going out and buying rubbish companies, paying out high dividends financed by cheap debt, but it's just something to be aware of, and just to know that a high dividend isn't necessarily a good thing. Also, shares are usually more volatile and potentially less reliable in a downturn when compared with bonds and other fixed interest investments. For example, in 2020, the Australian government put a cap on bank dividends. I'll put up a screenshot here of what happened there, and other governments around the world introduced similar measures on limiting dividends as well. Although bonds aren't without risk either. But the idea is, guys, that you want to spread your money around, not just by different funds or by different ETFs, but also by different asset classes. So you might have shares, bonds, cash, fixed interest, maybe some commodities, stuff like that, gold and silver, crypto, whatever it may be. Spread it around, don't put all your eggs in one basket. That's the way you reduce your risk. But at the end of the day, everyone has a different risk profile. Everyone has a different appetite for risk. So you need to invest in a way that's going to allow you to sleep well at night. And dividends aren't a sure thing. Nothing is a sure thing, but as part of a diversified portfolio, they can be a great little earner for you. All right, so how do you get to this point where you can live off dividends? Not all of us have 300 grand or whatever lying around in our back pocket with nothing to do. Most of us don't, but there is a way to get there, and here's how you do it. You start small. Even if you don't have much, the important thing is that you make a start and you get used to putting that money in week after week, month after month. But then look to start ramping it up, guys. Put in as much as you can. Keep pumping that portfolio. After a while, it's going to start to take on a bit of a life of its own. The portfolio will start to rise off its own back. So all you got to do is stay behind it in the early days, keep pumping it, and in time it will grow. And if you've been reinvesting your dividend, this will help as well. Then when you get to a point when it's making a nice income, you can switch off the DRPs and start paying out dividends in cold, hard cash. There's no denying that it is a long, hard road. But if you hang in there, the rewards can be significant. There's nothing really to lose here, guys, in the respect that whether you get to a point where you're living off dividends or you're just supplementing your other income, it's a win-win in that respect. It's still money hitting your bank, whether you get out of bed or not, and that ain't a bad thing. And just remember, guys, I'm not a financial advisor and you need to do your own research, okay? This is not financial advice. All I want to do here is explain how it might be possible, a way that you might go about doing it, and also how I look at it in some respects, but please go out and do your own research. All right, guys, that's it for the video. Thank you so much for watching to the end. If you got anything out of this, please hit the like button. If you want to see more videos that will teach you to keep more of that hard-earned in your pocket, please subscribe and catch you in the next one.